It's remarkable. If you, again, we play this game a lot. If you had told me all the time, if you had said they're going to say they're going to pause, but to say maybe 2 rate hikes this year.
Sell off.
So the market's S&P's down 80 handles.
Absolutely.
And at one point it was down, 40-something handles? I don't know what happened late in the day to get back to unchanged, but I'll say this as well. 2s10s went out to about 94 basis points like that. Now, it's fascinating. If you listen to Michael Schumacher yesterday, Steve, I don't know if you heard this. He said from 159
to 226.
The cha-cha-cha.
And that's exactly right.
Whatever move happens in the bond market.
He was, and the stock market as well, and he was exactly right. So, Steve, I'm with you. I believe what the Fed is saying. I believe they're earnest in this. The market's clearly not buying it, though.
Steve, are you going to? I could ask Steve a question because I still see his box right there.
He's still here.
Steve, why are we talking about 2%? I know 2% was untouchable when there was no sign of inflation. Shouldn't it be 3%? Is the door open to that? Why is 2% the number? Why shouldn't it be 3%, 4%?
I mean, it's a good question, but it's 2% because it's the level that they promised. It's the goal the target that they had. And the fear is that if they change that rate, that their credibility will just go to hell. There could be a discussion about changing it if they hit the 2% target and then say, you know what, 2% is too tight. We want to go to 2.5 or 3. But I don't think they're going to change it till they get to that rate. And there's, I think, a decent argument to be made for 2%, which is that it's not 1 and it's not 3. That 3 is a level that businesses start to talk more seriously about the impact of inflation on their businesses. But just one thing for Tim on this issue of whether or not to believe the Fed. Right now, that probability is 60%. But, I would think you could take it meeting by meeting. And one idea that's out there is that forget this data dependence, forget everything else Powell said today. All he really wanted to communicate is that they want to hike every other meeting like we did in 2019. And that's what they're about to do.
It's interesting. Steve mentioned Jeffrey Gundlach's response immediately, and so he doesn't think they're going to hike again. But he also actually takes issue, I think, with the indication of what the economy is doing. And you heard that. And it's interesting. We talked about it last night. Look at how small caps traded today. So look at the Russell 2000. Look at how energy traded today. Look at how financials traded today. They didn't trade particularly well. All 3 of those sectors, are down considerably from their 2021 highs or their all-time highs made in the last, let's call it 18 months or something like that. So it's kind of interesting because, again, guy said, I don't know what the heck happened into the end. You saw the move the NASDAQ 100 made. I mean, like, NVIDIA rallied 6%.
We're at all-time highs on semiconductors.
I mean,
so let's be clear about where the market is. No, I mean, it's definitely.
But again, it's the same stuff, like leading the charge in a way.
It remains the safety trade, though. And the reason why the Russell can't perform is that he didn't take July off the table, which means it's going to be tougher for those small companies to survive in a
But the more this happens, it's just the more danger that presents, and we used to think, and Steve said something like the market is coming the way of the Fed or something like that. The stock market is really working against the Fed right now because a bubble is inflating, and by raising rates, you're trying to avert that. You're trying to avert a housing bubble, right, by doing this. But there's no cares. So the nature of investors and the risk that they're willing to take, that should be concerning to people. And I think that's probably what concerns Gundlach a little bit.
Steve, do you think that irks the Fed?
I think it does. I think there's a really interesting dynamic right now, which is that the market is coming to believe that this AI thing is for real. And it has dramatic implications for both company earnings and for the economy. The Fed can't really factor that in unless at some point in time it starts to make a decision that this is a real productivity enhancer and a reason to lay back.